Hey folks, I want to give you a brief introduction to the best Canadian utility stocks for those of you looking for those juicy dividends, that passive income from a sector of the market that is largely underexposed in those broader indices. But we're also going to take a look at two utility ETFs. And I want to explain to you what I like and what I don't like about this sector, because a lot of these utility stocks are trading at major discounts right now in this interest raising and recessionary environment. If that is a conversation you can appreciate, damn it, hit that like button, because I know many of you are looking for that passive income here, folks. So getting into this with the most requested, bar none, has got to be Algonquin Power and Utility Corp, a stock that has just been absolutely crushing it for the last 10, dare I say 20 years they've been publicly traded, but recently they're trading over 30% off their recent highs with a whopping dividend yield of 6.72%. These high yields are dreams I never thought we'd foresee again here, folks. But let's get into what is going on with Algonquin Power and Utility. For those of you that are new to this company, they have large exposure to the US, but because they've done a lot of acquisitions through their subsidiaries, they have over 8,000 miles of gas distribution lines, 14,000 miles of electricity distribution lines, 5,000 miles of water distribution mains, but they also have this really incredible exposure to the renewable sector that has been growing exponentially. I mean, you look at the year-over-year growth in hydro, wind, and solar, and their thermal, and it's been a very good proponent of those growing dividends that we've seen in this company, arguably being one of the most pronounced Canadian utility stocks for dividend increases. I mean, you go back to 2014, they were only paying 0.087 cents per quarter, where today they're paying 0.18 cents per quarter, which is just astounding. But some of the reasons the stock has been falling off aggressively, and a reason a lot of you have been asking me, is this a buying opportunity? First and foremost, this article from the Motley Fool kind of highlights a lot of this with the rising interest rate pressuring Algonquin Power. Most utilities, almost all utilities we're going to look at, are fairly debt loaded. They're kind of similar to REITs and the telecom providers. I mean, you really don't expect people not to pay their hydro bill. So with that stability, usually these companies have to take a lot more debt on to build out the infrastructure. So total assets sit at about 16.7 billion against current total liabilities here at about 9 billion. So just over a 50% split between those assets and liabilities. Now, obviously AQN has a track record of, paying solid dividends. The annual or 10-year dividend growth rate has been 9.5%, which is just absolutely bonkers in my opinion. But here's where AQN stock's growth will come from, because they made some pretty heavy investments. Algonquin has a capital plan of about 12.4 billion from 2022 through 2026, but it does not make sense for the stock to push out equity now. We're probably going to see less share dilution, but apparently management is setting up an asset recycling that is expected to raise approximately 277 million and 107 million across the sale of partial interest in 3 wind facilities, something I'm not the biggest fan of. But the press release stated that AQN will continue to oversee day-to-day operations and provide management services to the facilities. Management expects to close the transaction by the end of 2022 and therefore won't need to issue equity for now. So basically, they're not taking debt out of the stock price, which is better for you as a shareholder. You're not getting diluted, but at the same time, they have to come up with that money from somewhere. Now, Algonquin is also in the process of acquiring Kentucky Power for an enterprise value of 2.65 billion, which is US 200 million cheaper than before. So they're getting a discount here. Kentucky Power will increase AQN's regulated electric utilities to almost 80% of AQN's business, which should improve the stability of AQN's business performance. Now, analysts are relatively bullish on this stock, guys. They're giving it a price target of $15, which is obviously about 30. Well, maybe, we're kind of rallying back here a little bit, but you're still getting a relative discount to what analysts are putting as a price target. Another concerning aspect of these businesses is that natural gas segment, guys, because natural gas is something utilities have been leaning in heavily in this explosion in value of gases. And we can see, though, in the recent commodities crash, it finally took natural gas with it. So a lot of utilities are getting hindered by that segment of their business, not going to be seeing the same kind of margin rates they were recently seeing throughout 2022. But that's Algonquin Power and Utility. And I'd state, if you're looking for those discounts, it's a great time to be picking some of these up. I think Algonquin Power is going to be around for a very long time, and those dividends are still sustainable. So I'd have no problem picking it up here. Now, Northland Power, bar none, my favorite utility stock in the Canadian markets. This one's only paying about 3.08% currently. And since the recent highs of roughly toward the end of 2021, it's trading down about 23%. Now, this one is the fourth largest wind and renewable publicly traded stock globally. This thing is fabulous with 52% of their current income coming from offshore wind. They have onshore wind making up 24%, efficient natural gas at 16%, so that natural gas again, and then utilities at 8%, guys. This one, however, not the dividend king we would love to see. If Northland Power could just do more dividend increases, it would probably make it the best stock, in my opinion, to buy in Canada. But just taking a look, guys, the last time they did a dividend increase was something back in 2017 when they went from 0.09 cents to 10 cents. But keep in mind, this is a monthly paying stock, and they also give you a discount if you have enough stock to reinvest. You can set up a drip enrollment. They will give you a discount, I think, of upwards of 3 to 5% on the reinvested shares. So it's one way to get a discount on the stock in the current market environment. But Northland Power, guys, their growth strategy is what blows me away the most. Is all these countries are leaning into offshore wind, especially when you look at places in the North Sea in Germany, obviously Taiwan, Japan, some of these areas kind of over in the eastern world of things. They have everything from that onshore wind development in New York. They're partnering with a lot of municipalities, Polish offshore wind, guys, the North Sea in Germany, as mentioned, Mexican solar. It's just a very pronounced company that I think is going to continue to be in this renewable sector. And again, similar to these other utility companies, guys, assets 12.8 billion versus liabilities at 9 billion, almost 10 billion. So this one, out of all the other ones, is a lot more leverage. But again, they have an incredibly large pipeline of growth right now, and their earnings have been relatively beating for the last few quarters. So, I mean, this one's kind of a give and take. You're going to be getting something a little bit more leverage. You're not getting the same dividend increases, but the growth of this company has been far better than a lot of the other utilities. I mean, since their inception back in 2011, 2012, 10 years, up 137%, not including that dividend. So definitely a growth beast in the utility segment. But let's talk about Hydro One. This is another one of my favorite utilities by far. As you can see, each utility we're looking at now is kind of hyper focused on specific assets or specific aspects of the utility sector, with Hydro One paying a 3.41% dividend yield currently, only coming public back in 2017 as a government spinoff. This used to be owned by the Ontario government. Now I think they have about a 40 or 50% stake in the company. And we can see as the government is actually, regulating this company, they're going to do a good job at that. The government's not going to mess around as much. And just taking a look, guys, they have 30,000 circuit kilometers of transmission lines. This company is almost purely focused on line in and line out. So when you see, if you live in Ontario, it's likely if you're in the GTA and you see hydro lines coming into your building, they're likely Hydro Ones. And on top of that, guys, as the the real estate sector continues to blow up and there's a lot of new construction, a lot of new condos, it's just going to add more distribution lines for Hydro One. So I love this company for that reason. And the dividend increases since this company has become public have been very pronounced as well. They've been raising it almost twice a year recently, generally once to twice a year, which is pretty incredible considering the current quarterly payouts 0.279 cents. So something good for the dividend lovers out there. And again, taking a look at the assets, 30 billion against a total liability of about 19. A little less leverage than Northland Power, but a little bit more than Algonquin Power and Utility. And the final utility before we look at these ETFs, what I'd really recommend is Fortis. This is by far one of the largest companies in Canada in the utility space. And this one's 5-year performance has been a little lackluster, but when you take a look at that long chart here, guys, this thing has done a fabulous job and actually has the history to back it up. I like utilities that were more or less created in the 80s and 90s because it gives us an idea of how well they've been able to perform and what management's done. But with a 4.36% starting yield, this is probably one of the ones I put at the top of my list because it kind of brings and encompasses everything that we've just talked about, guys, because they have 10 regulated utility businesses across North America, primarily focused in North America, 3.4 million electric and gas customers, 9,100 employees, 99% regulated utility assets, which means they're regulated from the governments, municipalities. They're the ones that kind of introduce and allow these companies to do what they do. It's just a great diversified business all in all. And the thing that I like about this company is they actually focus on being a dividend first kind of company with 48 years of consecutive dividend increases. Now, again, not as pronounced as Algonquin Power and Utility from the dividend increases, but 6% average annual dividend growth guidance to 2025 is still pretty insane considering you're already getting a massive starting yield of that over 4%, which I think is a good, healthy starting yield in a market environment like this. And just taking a look, guys, Fortis is going to give you a total assets of about 57 billion against a current total liability of 36 billion. So this is by far the biggest balance sheet of the bunch. And they've been missing earnings recently, probably because of, again, the interest raising environment, write-downs, things of that nature. But Fortis is one of those ones that we're going to see at the top of the list when it comes to a lot of these ETFs as well. So let's just take a look at the iShares S&P TSX Capped Utility Index. So I do not like these specifically focused ETFs in Canada. A lot of people kept saying, well, why don't you buy real estate ETFs? Why don't you buy utility ETFs? And it's primarily because the fees are way too exuberant. I mean, all the major ETFs in these specific focus sectors are almost at 0.5%, which a lot of them pay about starting yields of about 4.5%. So they're wiping out, you know, a huge percentage of that dividend. And I'd rather just buy the individual utilities themselves if I was going to go about it. But now that these are trading down, a lot of people are finding them attractive. So taking a look at this one, guys, the diversification set starts with 19% weighting in Fortis. So we can see they're very under diversified as well. They're super concentrated in the upper market capped area of utilities with Brookfield Infrastructure Partners, Emera. We can see Hydro One in here. Here's Algonquin Power, Northland Power. So all these are incredible utilities. And if the utility sector is something that you appreciate, I would go into these ETFs and start breaking down the largest market cap or the ones they weight most to the top, because you can see, man, these top three utilities make up, you know, almost 50% of this entire ETF. So I don't want to pay somebody 0.5% to manage that when they're so concentrated. There is a new utility ETF that came out that I've been very intrigued by, and I would be all over it if the again, that fee wasn't so exuberated, which is the Horizons ETF. The ticker's UTIL, which is the Utility Services High Dividend Index ETF, another kind of dividend focused utility stock. And what I like about most about this ETF is it doesn't just encompass purely the utility sector. It looks as telecoms as utilities as well, and pipelines. So you get Pembina Pipeline, Enbridge. Enbridge is probably one of the greatest dividend stocks in Canada of all time, but you also get Hydro One, you know, Brookfield Infrastructure Partners. But this is where we start getting into the infrastructure of telecommunications with TELUS. You can see we have Rogers, Bell Communications in here, Emera, Fortis, all the greatest stocks that I absolutely love from the energy and utility sector and communications sector in Canada. So I would love to buy this. It yields about 4.5%, but again, you're paying almost 0.5% to get management of a very concentrated ETF. But I would love to buy this ETF. There's just a few problems. First and foremost, they only just introduced it last month or a month or two ago, and there's no volume to the stock at all, which makes me a little concerned from selling this ETF down the road. Might be a hard one to get rid of when there's absolutely zero volume trading in it as it currently stands. But these are my favorite utility stocks in Canada. Just a really brief overview, and I would recommend pretty much buying all the mega caps if that's what you're looking for in your portfolio, if you're more cash flow focused. It's an incredible sector to get exposure to, and again, these are largely underweighted in any of the major indices. But I'll pass the question off to you at this point. I'd love to know what utilities you own, what you think about these utilities in this current environment, and are you buying them today? But stay cool, stay awesome, and as always, I look forward to catching you in the next one.